do believe we have a quorum. So
Do you want us to come in?
if everybody's ready, I'd like to call the meeting to order.
I'm going to leave my things.
Good morning, everybody.
Good morning.
If I can find a chair that will lift me up to table height. All right, are we ready for the roll call?
You are. Sue Burton,
Here.
Laura Bellin,
Present.
Gary Waters,
Here.
Matthew Crutcher,
Here.
David Harrington, Christopher Westerman,
Here?
Elizabeth Gooden,
Here.
Alice Kelly,
Here.
Solomon Ashby,
Here.
Derek Challenger.
Here.
Everybody's present.
All right, did everybody have a chance to review both the June and July minutes?
Yes.
We had a couple of changes at the last meeting, but we couldn't approve any of them because we didn't have a quorum, so the modifications have been issued. Could I have a motion, please, to accept the minutes as sent?
I move to accept both June and July minutes as presented.
Second.
All right, everybody in favor?
Aye.
Aye.
All right, thank you. And then are we ready to go into the closed meeting? I
Yeah.
think Ms. Bellin has the,
Yes. I move to go into closed meeting as allowed by Virginia Code 2.2-3711 and 2.2-3712A pursuant to the applicable exemptions, Virginia Code subsection 2.2-3711A8 for the purpose of consultation with legal counsel employed by a public body regarding specific legal matters, requiring the provision of legal advice by such counsel, and pursuant to Virginia Code subsection 2.2-3705.11 and 2.2-3711A1 for discussion of personnel records containing information concerning identifiable individuals as it relates to eligibility for retirement benefits.
all right.
So I think we need to have a motion.
No. Someone will need to adopt that motion and.
I'll make that motion.
Second.
All right. If we're going to go into closed session, I believe we'll need to ask you to step out for a couple of minutes.
Yes, ma'am.
And we'll be closing the door. We'll open it back up as soon as we're done.
Just so everyone in favor, I didn't.
Yes, is everybody,
Aye.
Aye. Are we ready to move on to the applications for retirement, of which there are none, is my understanding?
We had 2 deaths. Eileen Cotton from the PRS and Laura Freeman of the PRS. Neither one had joint or survivor benefits. Active participants are 21 in fire and police and 19 in the Portsmouth Supplemental. That is different from last month when it was 20 and 20. Found out that one individual who was fire and police has somehow been coded as supplemental, and so that changed it and moved the one in there.
All right. The schedule of historic funds flow report.
This will be the end of the year. As of the end of the year, year-to-date, we began with the beginning balance, $229,753,100.33. Interest income for the year, $3,409,195.27. Administrative expenses for the year, $311,436.91. Return of benefit payments was $17,330.84. Recurring benefit payments, $30,437,165.74. That does include the $500,000 that was used for the supplement back in March. Employer contributions, $8,596,392.95. We had a realized gain of $151,786.86. and an unrealized gain of $19,451,751.23. Ending balance for the year, $230,630,954.83.
Questions?
I got a question about this retirement plan services revenue analysis. You got 1, 2, 3, 4, 5, 6 of these funds that we didn't earn a penny with.
I think
I don't
that's,
think we have gotten there yet.
John Hancock's revenue.
Huh?
That's John Hancock's revenue that the fund is paying
Oh,
them.
that's, okay, thank you.
Okay. We ready to move into unfinished business?
First part of the unfinished business would be the investment committee. The first thing is the investment allocation. Apparently, we need to approve the new managers, not just that we want to make these allocation changes, but we need to make, I think it was inferred when we made the motion and voted on the allocation plan that, oh yeah, we're going to take these managers. Well, we need to specifically move to accept these new managers and approve it.
So moved?
Second?
All in favor?
Aye.
All right. Make sure the minutes reflect the name of the manager so that we do have that. Okay.
I'll let you cover the RFP.
Okay. The investment committee met via meeting last week.
Last week, yes, sir.
Last week. And we have an RFP draft. We have that working through purchasing in the city attorney's office, and we'll be getting that out on the street in the next week or so, pending their comments. And we have a very tight time frame for publishing that based on when we get the comments back from the purchasing and we haven't given it to the city attorney because we're waiting for the purchasing, so don't think that I haven't gotten that yet. But once the city purchasing agent finishes his comments, we'll send it to the city attorney and then we'll publish that.
Thank you.
We expected to be out there by what date?
Hopefully very week or two. Shouldn't take too long.
But prior to our next meeting?
Yes, it'll definitely be part of the next meeting. The
Governance
bylaws? The
policy
governance
status?
policy. And we changed that to bylaws because that seemed to be what everybody was using as bylaws.
Okay.
And so made two changes on page 2 in the middle, and this was highlighted in yellow, but it's like you guys don't have colored copies, but it's obviously grayed a little bit. There's a section in the city code for investment purposes only. The funds created by this article may be combined with the funds of the Portsmouth Fire Police System. All registered securities and such combined funds shall be registered in the name of City of Portsmouth, Portsmouth Supplemental Retirement System. So both the fire and the police and the supplemental systems are together for investment purposes. And every change in registration by reason of sale, assignment, transfer, or disposal of such securities shall be accomplished by the signature of the Chief Financial Officer, and securities shall be delivered by him when directed to do so by resolution of the board. That's a direct quote from the city code. So basically, Sue, that means the CFO should be signing the transfers when we go back and forth, which I know that is a relief to you. As chair, she was signing most of the contracts, and so when we get to the transfers of the funds, that actually has to be signed by the CFO. Okay, so that's one change that we had.
You don't have to sign $1
then
million
this-
transfers anymore?
Then the second change was on page 8, which is the last page, and this is, we had talked about putting in interest for if we have somebody that, for whatever reason, was delayed in getting their payments, their retirement payments. One of the things that, there's a lot of different indexes out that you can use for different various things. To me, a reasonable index would be the U.S. Treasury. If an employee or a retiree gets a paycheck, typically they're putting in their checking account or they're being very conservative. And so to us, a good interest, a safe yield interest would be the U.S. Department of Treasury yield curve rates for the first business day of year one of the the 1 year rate. Yes.
With a 1 year rate.
Right. I probably should have put
Okay,
a
because
comma
that
there,
doesn't,
1 year rate.
I didn't understand whether that was the 1 year rate or the.
Right.
Okay.
And so we figured that's a good savings account, safe yield. It's something we can get at very easily. We take the first day of the business year and use that for the whole year. And so that was our proposal, that we use that as if we're determining interest rates.
Is that good for
What is that
backdating
now?
too?
Yes.
Do you know?
So I printed that
The
out.
10 year's like 2.24.
Yeah, the 10
something
year's
like
2,
that.
yeah.
So the 1 year.
The 1 year's
what?
got to be,
Under 1?
it's under 1. It's
Yeah.
probably
Yeah.
around 75, 80
She
basis
looked at
points.
three
too
different
low.
years, 0.51, 0.64, and then for this year, it was 0.81.
It seems really low.
But interest rates are.
Yeah, but I mean, the 10 years at 2.24 or something around that. That seems-
So for a particular person, so if we had 2 years ago that they should have gotten their check. So we'd use the 2015 rate, the 2016 rate, and the 2017 rate based on when they should have. So the amount that they should have gotten in 2015 would be the 1 year rate for that 2015. The 1 year rate for 2016's amount would be the January, whatever was on January 1st of that 1 year.
So are you suggesting a 10-year average?
I don't know. I guess I'd be curious to see what other pensions do. I mean, that seems pretty low to me. I don't know if that's standard or if that's just me. If that's, let me rephrase it. I just want to be standard, similar to other pensions.
Sure.
So if that's what they do, I'm fine with it.
Sure. Well, I can do some more research on that then, because I just was proposing something that I thought was conservative for our pension, that, typically, retirees, when they get the pension, they're not investing it the way the system invests it. So the system invests a large chunk of money for many 50-year horizon, if you will. And so the rate of return that we're using is 7.25. Typically that's not what a retiree is going to get with their pension. They're going to have a chunk of money and they're going to put it in a checking account or a savings account. They're not investing their money. It's typically for a payment to pay their bills. So we were thinking a conservative savings account. Those savings accounts don't make more than the U.S. Treasury bill.
So, for example, if the IRS owes you a tax return and they don't pay it on time, they pay you the federal short-term rate plus 3%, which is actually earning something, right? Whatever the short-term rate is, the rate's set every 3 months, interest compounded daily. So if that's what the IRS is doing, I don't know. I don't know if that's the right thing or
It's up
not
to the retirement
maybe
board.
ever.
So if you want, I mean, I can send over what would be done on a ERISA corporate plan, because that would be
That's
regulated,
okay.
and I can share that, and
Wanna
if
do
you
that,
take
no
that into
problem.
consideration.
I think that'd be good.
Okay.
And this is on delayed benefit payment?
Yes.
Okay.
So do we want to wait to approve the bylaws until we have that figure included in it? So it's all inclusive of all the changes that have been made?
Thank you for all the work you guys have done on this, by the way.
Yeah.
Well, it's been interesting as we get into situations. We should conclude that, so it's a living document. So while we might have it, I think it's something we need to revisit every year.
In our annual meeting.
at the end.
And as part of that, unfortunately, Sergeant Crutcher's not here again. I still have the terms. He had asked about that.
Well, you attached them in the minutes, so he should have had an opportunity to see
Just in
them.
case you missed it, Mr. Waters, you're on your first term, which will end on the 30th of next year.
Yours is this year, then. You're gonna renew, aren't you?
You're getting close, Chris.
You're gonna renew, aren't you?
All right. Anything else regarding the bylaws?
That's a good approach.
Okay, moving on to the record retention policy, the status update.
We have, I would say about 80% done. Gail and I are going to take tomorrow and just finish it up. Thank you so much for volunteering. As we started looking at it, it's too much mix and mash, and some of it's work and some of it's not. So what I was thinking is maybe after we're done, if you want to take a look at what we've done, that might be
It's easy to understand.
Yes. And so that way somebody knows what we have and what we're sending to
I'll be happy to.
our record management company. And so we're going to scan the records that we need to hold permanently. Some we have to hold for 5 years if there's the audit and that type of thing. The permanent records or minutes, any employee records have to be held for 50 years after an employee leaves the service. And we had talked about, we have a pension book that we found that has a list of employees, and so we're going to be scanning that. We're also going to be working with John Hancock to make sure all our records are up to date with the list that we found. We have found an old pension book that's typed with people's birth dates and their date of service, and so we're going to, smells old even. And so we will be working with you on that, making sure we have all their list of retirees in there.
Okay.
Okay, are we ready to move on to new business? The John Hancock invoice approval, which we weren't able to do last month. I do believe it's attached again, if you all have a chance to look at it. It's right after,
I make a motion to be paid.
Second.
all right, all those in favor
Aye.
signify by saying aye.
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 So approved. So unless there's anything else that didn't make it to the agenda, I think we are ready for our visitors to go ahead and start.
Great. You guys. Good morning, everybody.
Good morning.
Good morning, everybody.
Good morning. We're first going to speak from this book. It's the skinnier one, yes, that we passed out at the start of the meeting. There's a couple of things we want to cover. We want to cover what's going on in the capital markets during the second quarter of 2017 and what our outlook is for the future, to make sure that the new strategy that we're moving to is still makes sense in light of what we think the opportunities in the capital markets are. And I'll sort of cut to the chase. There are the way we're moving, the new structure that we're moving toward is in line with where we see the capital market opportunities. But before we get into review of that, we thought it was important today to take a step back. So Greystone Consulting, which Jim and I are part of, have been engaged in sort of a new type of relationship with the board here. So we thought, given that we've been, our role and the purview of the advice we provide has expanded, and we've had this expanded role for about a year, we thought it was a good idea to take a step back and say, okay, what have we done over the last year? And we like to continually self-evaluate, and ultimately it will be you all that decide whether we're doing a good job for the pension system system or not. But we wanted to make sure that we talked about some of those things that that had been accomplished over the last 12 months in the expanded role that we had. And that's the first part of this presentation. So that's what I'm going to talk about the next 5 or 10 minutes going over with you. So on page 1, we just kind of recap what role we had historically and how that role has expanded over time. So Jim and I and some other members of the team came to visit with Alice and Gail. I think it was back in August or June of last year. At which point we talked about sort of the dual types of consultants that you were working with. We had Arlie on the one hand, and then there was our role, which was confined to sort of oversight and management of the Schaefer Cullen portfolio. We were asked at that point to potentially take on a broader role with oversight of not only Schaefer Cullen, but also, given our background and our area of expertise, taking a look at the asset allocation strategy and then having oversight of all the plan managers, not just Schaefer Cullen. And we'd also been asked to take on an expanded role in the board meetings. I think you've seen over the last several quarters, you're probably hearing Jim and I talk a little bit more than maybe what was the case historically. You know, the role that Arlie played, he was still involved in the team at that point, but I think you probably noticed you were hearing from Jim and I more. And that expanded role, quite frankly, fits really well with what Greystone does. Greystone is the institutional consulting arm of Morgan Stanley, so we work with pension plans, we work with endowments and foundations, we work with Taft-Hartley and union plans and public funds. This is our business. This is what we do every day we come into work. Greystone, at the end of December of last year, had about $280 billion in assets that we advised on across all types of institutional investors. That put us right at about the 13th largest investment consulting firm in the country. And so this is our bread and butter. This is what we do. Just a little bit of background on Jim and I. We're two senior partners of Greystone. We're both credentialed with CFA designations, and we've been doing this and working with clients similar to you for over 20 years. And no offense to Jim, he's been doing it a little bit longer than me, but I've been doing this for 23 years. Before I joined Greystone about a year ago, about 15 months ago now, I was with a firm called Mercer Investments, and Mercer Investments is the largest institutional consulting firm in the world. I worked with public pension plans when I was there. So I worked with the state of Florida, I worked with the state of Ohio, Colorado, Nebraska. So I'm deeply experienced in the issues you're facing, which is why I think it made a lot of sense to get Jim and I more involved in sort of the broader scope of services that we provide to you, given my background. So what are some of the things that we've done over the last 12 months? Again, you'll be the judge of this, but these are just a few things that we hope you see that we've provided. The first one on page 2, provide forward-looking proactive advice and capital markets review. So we're going to go over, again, what our review of second quarter of 2017 was, and then what our expectations are for the rest of the year and then going forward. This is really important to us, and I think what distinguishes us and how we work with clients is that it's fine to see what has happened historically, but we're really more interested in what's going to happen in the future, and we want to make sure our clients are positioned to take advantage of what our views of the future are. And hopefully those pay off. And fortunately, the new strategy that we're moving towards has worked pretty well. We'll review July's results. We did move a little bit of money around. We recommended a complete overhaul of asset allocation strategy, as we've been talking about, and we're moving towards. And that asset allocation strategy was really driven by the structure of your liabilities. So what are our benefit payments? What are our expected cash flows likely to be? And it's our observation that historically the liability side of the balance sheet wasn't necessarily considered when we allocate our assets to try to help fund those liabilities. When the new asset allocation strategy is fully implemented, so we're moving into areas of the market that are higher cost in terms of investment management fees. But we've done some other things as well, introducing passive management strategies, particularly in the large cap space here in the U.S. So when we're fully implemented with that new strategy, even though we're investing in higher cost, higher returning segments of the capital markets, we're not expecting to see any increase in investment management fees. So we're availing ourselves of that higher level of growth, that higher expected return, and we're paying about the same fee that we did under the legacy program. Really important from a governance perspective and a cost control perspective. Given sort of the dual consulting relationships that you had with Greystone and its expanded authority, and Arlie with the legacy advice he provided to the plan, you were able to reduce overall costs of the plan by 3.5 basis points by reducing or eliminating the consulting redundancy. So you're actually paying lower fees for, in our view, a much more institutional-like portfolio. We completely restructured the fixed income portfolio. As you'll recall, 6 or 9 months ago, we were invested in a stable value product that generated a cash return. We talked about the challenges of stable value products in the context of the defined contribution plan, and that's been fully restructured. We're in the process of revamping now with the board's approval earlier of the investment manager lineup by removing some managers that we don't have a high degree of confidence and that have been underperforming for quite some time, and implementing some of those lower cost strategies through the use of index funds, with Vanguard in particular. We're in the process of diversifying away from Schaefer Cullen at the start. They managed 40% of the total plan assets. We're going to be taking that down significantly. And the last sort of investment-related matter, we hope you agree that we brought a level of rigor to the board and investment committee meetings, again, by focusing on not only what's happened in the past, but how we expect the future to evolve, and using that view to advise you in a way that's going to set yourself up to generate the kinds of returns that we need to fund the benefit payments we have to make. A few things on the governance side. We've revised the investment policy statement to bring it up to institutional standards. We added a lot of detail around risk controls and roles and responsibilities of the various parties. We've recommended changes to how we evaluate plan success in terms of what kinds of benchmarks we use, and that brings us more in line with industry best practices and the practices of other public retirement systems. We're in the process of rolling out, once the new strategy is fully implemented, robust performance reporting, not only at the total fund level, but the individual manager level. And then lastly, on page 2, initiated transparency on costs and fees as well. A lot of the things we focused on over the last 12 months were concerns that were identified in the Davenport study from June of last year, you may recall. And on page 3, I've taken the liberty of reproducing a chart that they had in their book that identified some of the concerns we had and where we stand today in light of some of the concerns that they've identified. In June of last year, we had about 12 of the 15 criteria that represented some concerns to them or some challenges that needed addressing. And today, I'm happy to say we're pretty much all green in their concerns. There's a couple of things I do want to point out, though. Yes.
Can we make sure that council gets a copy of this so that they...
That's so funny. I was just thinking that.
Because,
Yes.
I saw this and I recognized it immediately, and I think it really shows a stark
I was thinking that we
difference.
have the council and the retirement board, the combined meeting, and that would be a perfect thing, that's going to be a little bit further down the road. I think
Right.
We can do a council
If we
briefing
may please
update.
borrow your,
Absolutely.
it's not trademarked or copyrighted.
No, it's
right?
not.
Very good, thank you. I had to
You-
get
you
that
bet.
out before
You
it
bet.
left my head.
But this was, when we first met, when Brian mentioned we were first coming on board, and we met with Alice and Gail, this was our pledge to you both, that we would work within 12 months or so to rectify this. And our quote at the time was, we'll try and green light as many boxes as we can, as fast as we can. So I would also like to say that we can't do this all on our own.
Yeah.
We had a lot of support from the investment committee and particularly from Alice and Gail. So they were deeply committed to getting this resolved.
So there's that. Wanted just to provide an update on where we stand on the new strategy as well. So when we got together with the board at the last meeting, the new allocations were adopted, and there was a sort of a defined phase-in plan from going to where we were to where we wanted to be, with the expectation that we were going to be fully implemented at the end of September. That's still the case. Now, we've slowed things up a little bit pending the board's approval of the new managers. But we did move some money around, I think it was shortly after July 4th, and then again right before the end of July. So we've moved some money in the direction of ultimately where we want to be. And this is what the chart on page 4 shows. So the dark blue bars are the legacy portfolio. The light blue bars are where we are at the end of July, and those, I probably couldn't have picked a worse color than white, but those pale green, I don't know, bars are ultimately where we want to get to. So you'll see we've reduced U.S. large cap a little bit. We funded an allocation to emerging markets, and there's some other kind of moving pieces, but in between, in the different buckets. But we're taking the steps and moving in the right direction of ultimately where we want to be. Now, how did that work for us is, I think, a reasonable question to ask. On page 5, this just takes a look at the results, estimated performance for the month of July. When we review performance in a little bit, we're going to talk about results at the end of June because that's the last quarter end, but wanted to give you an update through July because we did move some money around. Did it work for us? We estimate that our fund is going to be up about 1.12%. Had we not made those allocation changes, we think the plan would have been up about 1.02%. So we had about a 10 basis point increase in performance because of the moves that we made, and that translates into about $225,000. So it's always nice to get off to a good start, and recognizing that this is 1 month, but as we're going to talk about in a minute, the direction we're moving, we still think there's very strong capital market opportunities in places like emerging markets, and in developed non-U.S. markets in particular, and we'll talk about that in a minute. I think, so I mean, again, you'll ultimately be the judge of whether we're living up to your expectations or providing you the advice that you think has value to it. But as we took a step back and reviewed what we've done over the last 12 months, I think Jim and I, and hopefully you do as well, feel pretty good about the changes we've made and the direction in which the board and the plans are heading.
Very positive.
Great. Any questions on Brian's opening comments? If not, I will jump into the capital markets on tab 2. So I'm going to ask you to turn to tab 2, page 8. On page 8, in the center of the page, I notice we have some page numbers to the right, so I'll focus on the center numbers. So, quick overview of the capital markets. It was another very good quarter. particularly for emerging markets and international equities. In the U.S., healthcare sector returned a little over 7%, very, very strong, probably the strongest sector for the quarter. Energy was down a little over 6.5%. Telecom was the big loser, down 7%, clear laggards. There was some concern about delayed tax reform. Some of these sectors got a little bit ahead of themselves in anticipation of that. And of course, oil prices were quite weak. The Dow Jones Industrial Average was up 4%. The NASDAQ was up 4.2%, and the S&P 500 index gained 3.1%. The bond market also reported positive numbers for the quarter. Let's turn to page 5 for just a minute, and we'll start to look at capital market.
Page 10.
Page 10. A little bit more detail. So first, the U.S. equity markets. I have to draw your attention to the chart at the bottom of the page.
It's actually page 10 in the center.
Page 10, center page 10, tab 2. As an overall comment for the quarter, it was another quarter where the riskiest parts of the financial markets performed the best. And I think that's just a reflection of investor confidence in the global economy. We'll come back and talk about that confidence level in a little bit. But that's going to be the general theme as we're looking at the numbers. So a little bit more specifically, the Russell 1000, which is a large cap index, increased 3.1% for the quarter. Large cap growth, higher PE, faster growing companies up even more, 4.7. Large cap value, more defensive names, lower PE, higher dividends typically, up 1.3%. So pretty significant gap between the growth and value in the large cap. Russell mid-cap index, mid-cap growth was up 4.2%, and mid-cap value was up 1.4%. Again, that difference between growth and value. And then finally, the Russell 2000, which is a small cap index, was up 2.5% for the quarter. So slightly underperforming the S&P 500 for the quarter, but you can see the 12-month number for the small cap index, the Russell 2000, up almost a blistering 25%. So taking a little bit of a breather. On page 11. Look at global equity markets for a moment. And here we can see the MSCI EAFE index, a benchmark for international developed equities, increased 6.4% for the quarter. The MSCI Emerging Market Index increased 6.4%. And the S&P 500, as we said, increased 3.1%. So a couple observations. Again, MSCI EAFE International developed growth up 7.7%. So that same trend. And if we look at the EAFE now for the 12-month period, it's up 20.8%. And now it's ahead of the U.S. for the trailing 12 months, which we just looked at was up 17.9%.
And we got into that market now, so is that part of the reason why our returns are a little bit higher than they would have been if we had stayed in it?
That's right. We put a little bit more money to work there in July. Yep.
Correct. And one of the biggest delta shifts in asset allocation will be in the emerging markets. I'd like to draw your attention to the MSCI Emerging Market Index and look at the 5-year annualized numbers. The last time we were here, we talked about how international equities, developed equities, had underperformed the U.S. for a considerable period of time, and we expected that gap to close. So indeed, with a very strong performance in international equities we saw this last quarter, that gap continues to close. But it's still about 65% of where the U.S. markets have traded over the last 5 years. But if I can draw your attention to the last block in the graph, MSCI Emerging Market Index at 4.3%. You can see that's still way below both Europe and U.S. numbers. And we're still making an increased commitment to that space because we still believe that there's ample growth. That really has been an underperforming asset class for a number of years, and we think we're starting to see some real turn in momentum there in terms of earnings. Moving on to page 12, capital markets for the U.S. bond market. The bond market registered positive returns for the quarter. The Barclays U.S. Aggregate Index, which is a general measure of the bond market, increased 1.4% as the Treasury yield curve flattened during the quarter. The actual 10-year U.S. Treasury note declined in the quarter, ending at 2.3% from 2.38 at the end of Q1 17. And again, consistent with that riskier asset comment I made earlier, the riskier part of the bond market, high-yield debt, also increased during the quarter, and that was up 2.2%. The rest of the slides cover hedge funds, real estate, and private equity. If there are any questions about the markets and the performance for the quarter, happy to answer those now. If not, we'll move into our views on the financial markets, which starts on page 15. So as Brian mentioned earlier, we think one of the tools that we have that separate us from other consultants is, and I know it's one of the reasons I think Brian really enjoys being part of the Greystone Morgan Stanley team, is we really lean into our capital market expectations. So we have analysts around the world, I sort of call boots on the ground intelligence, and that comes back to our Global Investment Committee, which provides us with tremendous resources to help us build portfolios in understanding what's happening in local financial markets. So the last time we met, I talked about the fact that Morgan Stanley's Global Investment Committee was quite bullish. And not only in this room, but in other meetings, it raised some eyebrows about how bullish we actually were. So we set the bar pretty high for ourselves. And it was an unusual time because we had political concerns about the new administration, what was going to be done, what wasn't going to be done. And as I said at the time, our view was we were looking mostly at earnings and not sort of the noise that was coming out of Washington. And so in January, our call for the strongest global market since 2013, which worked out well for us so far because capital markets are annualizing about a 25% rate of return this year. So very, very strong capital markets. Our bullish global equity forecast assumes that earnings continue to move higher around the world. We're going to look at a couple of charts that shows the power of this rally. It's not just in the U.S. It is really a synchronized global recovery. We certainly have some concerns, and they're outlined at the bottom of page 15. What are the risks?
It's almost as bad as Gail's cat.
What's wrong with my cat? We haven't heard of the dogs yet.
So I'd just like to review what we perceive to be the highest risks to our bullish call. One is that the Fed is further along in its rate cycling than we anticipate, meaning they continue to raise rates perhaps at a faster clip. And we know from history that faster rates could yield a recessionary environment if they overshoot and raise rates too quickly. We are starting to see some cracks in commercial real estate and auto financing market, so we're keeping an eye on those markets as the proverbial canary in the coal mine. Oil prices have been vacillating between $40 and $50 a barrel. We think they'll stabilize in that range, but they may not maintain that range. And then European Central Bank has been very, very accommodative, and like our Fed, if they decide to withdraw or taper sooner than we expected, that could cause a disruption as well. On page 16, this is a really good indication of how markets have reacted, and this slide is really meant to illustrate that it's been a very, very broad rally. Every major region has participated up to about 20% returns this year. But on the right-hand side, you see the fixed income market, except for high yield, has been really poor performing relative to equities. On page 17, despite claims to the contrary, the market breadth has been very strong. And so here what we're looking at are 11 sectors of the economy. This is the way capital markets are often broken down and looked at. And this is across the world. And you can see almost every sector, absent energy and telecom, has participated in the rally. So that's a very healthy sign globally. If it's a narrow market, meaning the market's being driven higher by a few sectors, say technology or healthcare, not as healthy. This is a very healthy chart for us. Page 18, this is the synchronized recovery that I was talking about, both in developed markets and emerging markets. So what we're looking at here, this picture shows emerging markets excluding China in the yellow line in the United States, GDP, and you can see they're both turning up right now. And it's actually the first time that we've really seen this since 2009, 2010, coming off the Great Recession. So it's one of the reasons, once again, while global equity markets have been performing well, we just haven't seen this type of global expansion. And on the right, you can see our forecast for both developed and emerging markets, and we have those forecasts moving up.
Why isn't China included in here?
Because it dominates the index. China is actually, if we include it, it would distort it further upward.
Okay.
So we're trying to show you that it's broader and deeper than just China. Because when we speak to emerging markets, it's sort of the 800-pound gorilla in the index.
Okay.
On page 19, because the Fed is raising interest rates here in the U.S., we get a lot of questions about what's happening with interest rates, and we think it's healthy to put this in perspective. So what this chart illustrates is how the 10-year treasuries have been falling now for 35 years. And there's been a lot of benefit from falling interest rates. Everything from auto financing to mortgages, consumers and corporations have benefited from these falling rates. Our belief, despite the Fed raising interest rates, is that we're still very much in this downward channel, where we'd get concerned if there was a breakout above 3%, because that would probably give us some concern that perhaps there's even more inflation in the system than we anticipated. But we expect that we'll continue to be in this channel for the foreseeable future. It'll take years, we think, of growth to accelerate to break out of this long-term channel. So it's healthy to put this little backup in rates in perspective of history. And it's part of the reason equity prices have performed so well this year. The final chart on page 20 just illustrates what the impact would be if we do get some form of tax relief, and the impact it would have on the S&P 500 if corporate tax rates were cut to 25%. So you can see it would have a different impact on different sectors, but overall we think it adds a net income implied change of about 6%. If that rate falls lower, obviously that number goes up. And we can debate whether or not that will ever happen, but we want some questions on that.
Well, yeah, so you might have already answered my question, but what is your all's feeling on the expectation of that actually happening, tax cuts?
We actually have somebody in Washington, as you would imagine, monitoring those questions for us. And our expectation is that there is a bipartisan need for a simplification of our tax system here in this country. And perhaps unlike healthcare, we believe that at some point, maybe in the first quarter of next year, we'll start to see some real conversation about that. It doesn't mean that tax rates will be higher or lower for individuals, and there's great pressure to make it tax neutral. And I think that will be the biggest challenge. But overall, a simplification of the tax code for both corporations and individuals, we think will happen. That's our best guess.
Other questions? Thank you very much.
You're very welcome.
So we're going to flip to this book now to review second quarter results.
All righty. The biggest book.
The big book, yes. And I'm going to ask everybody to turn to page 14. So I'm going to kind of go between pages 14 and 15, so maybe just kind of have your book opened to both pages.
Tab 2.
Oh, right, sorry. So the top table on page 14, this shows our total plans results relative to the benchmark's return, and we show it over various time periods. So for the quarter, our return was about 1.8%. And the benchmark's return was 2.4%. So we lagged by about, it's about 65 basis points, 60 or 70 basis points in underperformance relative to that benchmark. Now, if we think about the result, so a 2% return for a quarter is a pretty good number in that, you generally don't want to annualize quarters to a year, but that would put us at about an 8% return, and the actuarial assumption we have for expected return is 7.25. So, the second quarter's return, although it was below the benchmark, was good for what we're trying to do and achieve in terms of funding our liabilities. But the question becomes, why do we underperform for the quarter, right? And so if you looked at the individual managers' returns, which show up on page 15 and 16, there were a few that had rough quarters, or our investment with them maybe didn't underperform a benchmark, but maybe the conservative nature of the portfolio resulted in some of that underperformance. And that's really what we get to when we think about the Schaefer-Cohen's performance during the quarter. So Schaefer-Cohen, which shows up on page 16, they had a return of 1.7% during the quarter. The CBOE buy right index was up about 3.1%. So Schaefer-Cohen lagged that benchmark's return by about 140 basis points or so.
That's what it's supposed to do.
It's not
supposed to.
It's not necessarily supposed to. It's supposed to lag the S&P 500 index when equity markets are strong because it's much more defensive. But it should earn a return generally in line with the CBOE buy right index, and we didn't during the quarter. And so we did some analysis to figure out why that was the case. So as Jim talked about in his comments, growth stocks did exceptionally well relative to value stocks. If you looked at the Russell 1000 Growth Index, the return during the quarter was 4.7%. If you looked at the Russell 1000 Value Index, the return for the quarter was 1.3%. So there was pretty close to a 3.5 percentage point difference in the performance of growth and value stocks of large cap companies in the U.S. Now, the S&P 500 and the CBOE buy right index includes about a 50% allocation to both growth and value, whereas the Schaefer-Cohen portfolio invests in value stocks exclusively. So the defensive nature of that portfolio, being focused on value stocks when growth stocks did particularly well during the quarter, contributed pretty much all of the underperformance that we experienced during the quarter. And why we think that's the case is when you look at the Russell 1000 value index and look at Schaefer-Cohen's portfolio relative to that index, which is much more in line with their style, they actually outperformed that benchmark. So it was really the defensive nature and the style of their portfolio construction, which we knew going in, and this is why we hired them. You'll recall back, I think we have a 5-year track record now with this firm. The financial circumstances of the plan were very different back then than they are today. And so it made an awful lot of sense to be defensive in terms of our exposure there. Now, this is one of the things we're changing as we move to the new strategy, right? We wanted to bring the exposure down, their allocation down. They manage 40% of our overall plan. because we wanted to have more balanced exposure. We didn't just want value stocks, we wanted value and growth stocks, and that's what we're moving towards. So although it looks like Schaefer Cullen had a bad quarter, yes, they lagged the CBOE Buy Right Index, which we would hope they would keep up with. Their value orientation and the index's more core orientation accounts for all of that underperformance. A couple other managers I want to talk about as well. On page 15, sort of in the middle of the page, the fixed income foreign bond number, Templeton Global Bond Fund was down 1.3% for the quarter, and their benchmark, this BBG BARC, Global Aggregate Total Return, this is an index of non-U.S. And U.S. fixed income securities. So this is a global bond manager. That benchmark's return was 2.6%, so we underperformed there by a considerable amount. And we've talked about Templeton a fair amount with the board over the past quarters, and as we've talked about, this portfolio is really constructed to take advantage of an expectation that interest rates in the U.S. are going to rise. So they're short U.S. Treasury securities, and that's a strategy that should pay off if interest rates in the U.S. rise. As Jim talked about, 10-year Treasury yields in the U.S. during the second quarter actually declined. They were down about 10 basis points. So the fact that this portfolio was structured for a rise in rates when rates actually fell contributed a lot of the underperformance there. We still think that thesis makes sense. We are of the belief, as is Morgan Stanley, that interest rates over time in the U.S. will continue to tick up. It may take a long time for them to reach normal levels. But we continue to believe that the expectation is for higher rates. The other thing that hurt this portfolio as well is they had some short positions in currencies of the euro and the Japanese yen, and those currencies actually rallied during the quarter. So it's a combination of their view on interest rates versus their view on the U.S. dollar, which resulted in the underperformance for the quarter. I think it's important to point out, though, you look at the one-year number, 10.6, again, this is on page 15, 10.6% versus their benchmark, which was down over 2%. Their views of higher rates in the U.S. and their views on the euro and the yen versus the dollar has really paid off over the last 12 months. It's just, it took a little bit of a breather during the second quarter of the year. On page 15, the Hotchkiss & Wiley result, right below Templeton, it earned a return of minus 1.3%. This is a mid-cap value manager, and the mid-cap value index was up about 1.4%. So they continue to underperform. They've structured the portfolio to be overweight energy stocks, and energy stocks were one of the worst performing sectors of the U.S. equity markets during the quarter. And quite frankly, they had some really poor stock selections in that sector as well, in addition to an overweight to the worst performing sector. This is a manager that we are looking to replace. So given the board's approval earlier of the new manager lineup, this manager will be, our investment here will be redeemed in the next few days. And we will take that exposure to invest in a growth-oriented manager. So right now, in the small and mid-cap space of the U.S. equity market, we have two value managers, Hotchkiss & Wiley and Goldman Sachs. We want to keep Goldman. We want to get rid of Hotchkiss & Wiley and take that portfolio and get some exposure to growth stocks. So they've underperformed relatively consistently over a long period of time, but we'll have that portfolio liquidated and repositioned here before the month's out. So those were the three kind of underperforming managers, Schaefer Cullen, Templeton, Hotchkiss & Wiley. Offsetting that was some pretty good results, really, from the Euro-Pacific Growth Fund in particular. This is our developed non-U.S. equity manager, and that's shown on the bottom of page 15. So as Jim talked about, EFA and emerging markets in particular were really strong areas of the global capital markets during the second quarter. The Euro-Pacific Growth Fund was up 7.7% for the quarter, and the EFA index was up only 6.1%, so significantly outperforming that benchmark. Now, this is a portfolio that has exposure to both developed non-U.S. markets, and they have about a 20% allocation to emerging markets as well. So the fact that they had that 20% allocation to emerging markets when emerging markets did particularly well during the quarter contributed a lot of the outperformance we saw during the quarter, and quite frankly, the year-to-date period as well. This is a really solid manager with really solid long-term results and sort of consistently ranking in the top quartile of other non-U.S. equity managers. This is one we'd keep. This is one we've increased exposure to in July, and they're doing a nice job for us. Last thing I want to say, so you add all that stuff. You got underperformance from some, you got outperformance from others. And at the total fund level, we lagged that benchmark by a little bit, by about 60 or 70 basis points. If you flip back to page 14 and let's look quickly at the year-to-date period, we're up 6.3% at the total fund level, and our benchmark is 5.5%. So good relative returns there. I'll talk about kind of what's driving that result in a second. But good long-term results as well for the total fund. We're up 10.7% for the last 12 months. And again, this is the fiscal year-to-date period, so that's an important number to show. 5-year result up over 7.5%, and then since inception, 7.7. So the long-term results of the plan beating our actuarial assumption, which is important from a funding perspective. And for the most part, over the longer term, we've been beating our benchmark in terms of relative results. Now, just real quickly on the year-to-date result, so what was driving that 80 basis points of excess return? The Euro-Pacific Growth Fund, which we talked about, doing particularly well. And the Goldman Sachs portfolio, which we haven't really talked about, which is on page 15. Over the year-to-date period, they were up 1.9%. Their benchmark was up only 0.5%, so a strong result there. Good long-term numbers as well. And then the REIT portfolio as well. We have an investment on page 16, which is in global real estate securities. It's had a pretty good run over the last 12 months. You can see strong results in the quarter, year-to-date period. And 1-year result a little bit lagging over the longer term. But by and large, everything's all the managers are doing as we'd expect. We've got some conservative managers that we want to replace and that we're reducing exposure to. We lack some growth exposure in the U.S. equity markets that we're addressing with the transition to the new policy. But all in all, as I look at results here across individual managers and at the total fund, good long-term results for the plan. Any questions? Okay.
Just one final closing comment on the portfolio. I went through the results of the indices. Brian just reviewed the performance of the managers. And in the last couple quarters that we've been here, these numbers have been well beyond anything we've experienced in history. It's probably been, I'd say, the strongest bull market since the 1990s. And certainly much more predictable, much more stable, a lot more volatility in the 90s. And so we continue to challenge ourselves about how to build a better portfolio, recognizing that the results that have been achieved over the last couple quarters just are not sustainable numbers. And so we'd like to let you know that we don't believe, while we've been very bullish on equities this year, we continue to have a positive outlook on global equities. We still think we're in this globalized expansion that I talked about earlier. We constantly think about how to build a better, more efficient portfolio where we can achieve the target rate of return with the least amount of risk. And There are some things we've been working on or thinking about in the last month or two. We're still debating internally whether it makes sense here, but I just want you to know that we're dynamically thinking about the portfolio and how to add value.
All right, thank you very much. Are you up now, Tom?
All right, thank you. So question first, I just want to make sure I understood, if I heard properly. So going forward, investment portfolio allocation changes, those are going to be signed off on by the CFO?
Right.
So I guess the process then will be pretty similar to what we've been doing in the past. I'll just include you both on the communication. You'll sign off and send back in direction. Okay, easy enough. And then the other thing I wanted to ask, in the past few years, the schedule we've kept is that Andre or Kevin in some past years comes down in October for the October meeting to do the full valuation review, because the goal that the committee has asked is to keep it off cycle from the investment review. Is that still how you'd like to handle it, or is there any change in that approach?
I don't see a reason to change.
We still owe the actuary, I forget who wasn't Andre that sent it, but it was another person that
Probably
asked for
someone in his group.
Right. We have a new payroll system, and so we have to get the old system and the new system. So we're almost there. So we should
Okay.
have it probably by the end of the week, beginning next week.
Okay.
The information for all the statistics. We just had to figure in the new system how to pull all that information out.
Okay.
And then combine it with the old system. Next year it'll be much easier.
Okay, so I'll connect back with Andre, I'll let him know that, and then I'll also let him know about the October meeting. All right, so with regards to this report, I'll touch on it quickly. You know, I think actually, and this is something Alice and Sue and I'm happy to take feedback, is, you know, I think it makes sense to probably change some of this, and quite honestly, perhaps not report some of it. You know, you all, because you meet monthly, generally are looking at more current information than some of this quarterly activity. So, you know, if there's any thoughts on just those high-level participant transactions, if there's still value including this, we certainly will. But I think, you know, there's also an opportunity to just kind of add in some additional things that we might be able to report on a quarterly basis. So, you know, and again, the investment review goes in pretty extensively too with the allocation, and I think some of that, to earlier points, will be changing pretty significantly. So I'm going to transition, I think, move through this pretty quickly. I'll just do an overview of cost structure again, just to highlight the recent change, and then I just want to highlight an enhancement to the website. But really, as you look at activity on the participant, the monthly benefits, it's all stayed pretty constant. There really haven't been many significant changes in those. You'll see if you look on pages 8 and pages 13, you do see spikes in the fees reported. Again, that's because of last quarter was getting some of the older invoices paid through the trust. So that's why that looks a little bit out of line. Going forward, that'll seem more consistent as we move ahead. I'll comment a little bit on the activity through the dealing with the individuals in the plan. So on page 10, for the fire and police system, you know, the interactions we had with individuals decreased significantly in both systems from this quarter to the first quarter. You know, that's primarily was driven on the fact of there was increased activity because of the supplemental checks, and that drove a lot of especially phone activity. And then we have been making ongoing changes to website security. So I think up front there were more interactions with individuals, you know, resetting user ID information and that type of thing. So that activity is leveled off down to areas where we'll probably be more consistent, but we'll look to see how that plays out. I do want to add, too, that our participant service center has been expanding pretty significantly. We just brought in one of the largest
representative new hire groups that we've had. I bring this up. This hasn't impacted the whole committee, and just in full awareness, there have been a couple of situations where we've been involved with, a couple of calls that probably could have been handled a little bit better with some individuals. Again, we take a significant number of calls from the system, so, we hope that 100% always go as best as possible, but there have been a couple recently that have come back through, your group on your side that we've had to get involved with and help rectify and better explain some situations. So I don't expect that to be anything that continues. I think we've broadened the group that handles some of the calls for City of Portsmouth, and we just need to make sure that those individuals are up to speed with the provisions of the plan. So that's being addressed, though, and I have ongoing communications with the management of that group. And then with regards to the supplemental system, again, if you look on page 15, same type of activity decrease, especially number of calls and then sessions on the website. A lot of the interactions on a frozen pension system, if you will, mainly frozen, are pretty standard. There's pretty standard interactions with us, just confirming activity, questions on benefits, and updating. We've seen, again, spikes in people updating information to access their accounts online because we've been changing and adding additional layers of security to do that. So that's why you might see some of that activity increase. In Section 2, the plan expense overview. So a couple of things to highlight. On page 18, so this is just a summary of the costs for the retirement system. We did put updated fee schedules in place effective July 9th. There really were not substantial changes. The only thing that was updated was the elimination of the financial intermediary fee, and that, as referred to earlier, that's the 3.5 basis point charge that had been paid through the trusts or through the plans to Morgan Stanley, to Arlie Pritchard's group. So that was eliminated effective 7/8, and on a go forward, we've removed that cost estimate so that you can see the impacts of some of that.
Can I ask a question?
Yeah.
You mentioned it, Brian, in your comments, the 3.5 basis points decrease. Mm-hmm. And as I understand it, you guys are only paid out of Schaefer Cullen currently.
Currently.
So effectively, by telling us to move away from that, you're decreasing your Greystone, Morgan Stanley, your guys' income.
Our bosses probably didn't like it, but it's absolutely the right thing to do. And so, it's an unusual way to be compensated for a consultant, and hopefully through this process, if hopefully we'll be retained, we'll have a new fee relationship that eliminates that issue.
Okay. So that, just so that everybody's aware, that is a conflict of interest, right? Because you guys, the way that the structure is now.
It could be.
It could be. Okay.
But it didn't prevent us, I would say, from making the right.
And that's why I wanted to bring it up,
Yep.
because I think that, to me, shows that, you're giving us advice that we should be getting,
Yep.
despite the fact that we've reduced your income.
That's right.
Could be significantly,
Yep.
so that
Yep.
the board can understand
Yes.
that. So thank you for clarifying.
Sure.
And when we first discussed the findings of the Davenport study at that first meeting, we talked about changing the compensation, and it was just agreed that it would be addressed.
Okay.
That
Thank you.
certainly, thank you for mentioning. We appreciate that, but it certainly doesn't affect our willingness or desire to provide you with the best possible advice.
All right, so, and just as a reminder, if you go left to right, I won't go through all the specifics. I know we've done this before, but investment management, 59.5 basis points, or 0.59%, equated into a dollar amount there, just over $1 million. The John Hancock cost of 6.5 basis points. The elimination, as I mentioned, of the intermediary fee, and then the total of 64.7 basis points, and that does include a net of some revenue sharing that some of the investments pay back into the retirement system to offset some of the cost. So if you transition over to page 19, you can see, how that's reflected. And we generate these quarterly, so as the investment allocations change, these will change along with that. But if you take Goldman Sachs, you look across the line, assets as of the end of the quarter, $4.8 million, 2.8% of the total allocation in this plan. The expense ratio at 94 basis points, so that's the cost for the Goldman and the investment manager, equals a projected annualized amount of just over $45,000. Goldman Sachs is one of the funds that currently shares back revenue. So 10 basis points of the 94 comes back into the plan to offset cost. That amount projected out at $4,800. So then you go down, you add all of those up, and that's where you come up with, total investment costs and taking out total revenue to net what actually ends up being the billable. So again, our cost of 6.5 basis points is $109,716. Plans receiving $22,497 from the investment funds, and so it reduces the billable amount. So this will continue to change, though, with the investment lineup changes, depending on, those structures of those options that are put in. Okay. Any questions? Okay, the last thing I just wanted to mention is just on page 22. So just for awareness, again, I've mentioned over the last 18 months, really, we've been doing a lot of additional website enhancements, a lot of it around security, probably more so on the defined contribution side where individuals can take out money online. So there's obviously a bigger need to have additional layers of protection there. With a pension plan, there's more involved to get assets out. But with that said, we did recently put in another enhancement that if an individual does go out to access the website and forgets their credentials, if they attempt to change those, they will be sent a passcode it'll be sent either via text or email. They will have to put that in order to change their credentials to get into the system. If they have never set up contact credentials in the past, they're not going to be allowed to access their account online. They're going to have to call our service center and then walk through additional layers of authenticity. I'll go with that one. Thank you.
Or authentication?
Yes, that was where I was trying to go.
It's the librarian.
In order to get into their plan. So just continue to look for, additional opportunities in these day and age of account access and protecting things. So that's pretty much the update from my standpoint, unless there's anything else for me.
We paid about $1 million in fund expenses.
So just in awareness, that what I'm showing are projections.
All right.
So those aren't actual, backward looking.
Okay.
That's annualized projections looking forward, based off of current assets. So those aren't
Okay.
actuals.
What I was trying to get at is this year, the total for both plans, we had unrealized gains of about $19.5 million, and realized gains of $151,000. So a little over $20 million. And so we were paying about $1 million, and we earned about $20 million. This was a great year, though. And it also is our administrative costs, too. It's not just the
That's right.
fees.
Yeah, so there's, the additional, again, when you take away the investment revenue, the billable amount is outside of the activity of the plan, although it does get deducted back through the trust.
I'll look at that a little bit more.
All right, so we'll follow up. I'll connect with Brian on the next wave of changes, and we'll get that going.
We want to talk to you about the pension book and how to make sure we could double check all those names and make sure that they're on a.
Sure.
So we'll follow up next week or something.
Okay.
Okay.
Is there any other business at hand? we thank you all very much for making the trip down to see us. And luckily, you didn't arrive Tuesday when it was pouring down rain.
We were just talking, last night was the perfect night. It was.
Yeah,
It really was.
Gorgeous all day.
Yeah. So could I please have a motion to adjourn?
So moved.
Second.
All those in favor?
Aye.
All right, thank you very much.
Thank you.
Thank you all.
Got my yard working.